Good morning, everybody. On behalf of EKI, who has traveled a path of 1.5 decade from the very beginning of the carbon market, has seen the initial hiccups, which is on the verge of stabilization now. And possibly in next couple of years, this market will be in a robust and first steps towards internalization of environment in our mainstream development. And IKEA is poised to propagate green profits concept among businesses. I am taking this opportunity to thanks all the distinguished speaker who are joining us today for this important discussion on sustainable finance, sharing their valuable insights. As a passionate follower of the climate discourse in international, multilateral, and bilateral forum for the last 3 decades, where the subject of anthropogenic climate change spent initial almost half a century in theoretical or academic discourse. But though delayed, yeah, at least the world have come to a conjunction where it has been offloaded to the business domain, considering the urgent requirement of massive sudden change in our development approach. Just to highlight the reality, whatever actions have been initiated on the ground at all stakeholders level till date, we are still in a scenario which will affect a temperature rise of plus 3.5 degrees centigrade by end of century, whereas the target that has put us on a paper in the form of pledge, but yet there is no uh, detailed plan has been put forward and now action has been taken on ground. If we consider that into consideration, still we are in a temperature rise scenario of plus 2.9 degrees centigrade. So to bridge this massive gap where we are eager to restrict the global warming to 1.5 degrees centigrade, we have to accelerate at least 6 times with our action. And on a deadline which has long passed, an active participation of mainstream business are inevitable. And to mobilize the business to internalize the environmental parameters in their business goal, it is important that environmental parameter get very important positioning in business finance attribution. So the financial institutions hold the key and the positions to act like a super catalyst to push immediately the business sector towards a internalization of environmental and social cost as well as risks in their investment decision. Possibly we are just on the verge of correcting this big blunder which has been from the very initiation of this development model during 1850s with the industrial revolution. And I am very eager to hear the esteemed panelists about their perspective and learn the way ahead. I am also taking this opportunity to introduce our esteemed speakers. I do understand Mr. Rajiv Kumar, General Manager, Small Industry Development Bank of India, SIDBI. In constant of time, I will take I will pass on the mics to him early. Mr. Rajiv is a mechanical engineer and a combination and a master's in economics, postgraduate in financial management. He is working with SIDBI, which is the principal financial institution of government, financing development, micro, small, and medium enterprises. And he is also a part of green finance vertical of SIDBI, which is actively engaged in greening MSME sector. He has executed several multilateral and bilateral programs on financing energy efficiency and renewable energy projects in MSME sector. Considering the time constraint on his behalf, I will ask him to kindly put his thought first, and then I will get back to other panelists here. Thank you.
Thank you, Samrajji. First of all, let me express my thanks to EKI for organizing this program, which is very relevant uh, as per the present conditions. Sustainable finance for financial institutions is extremely important. In fact, uh, in the current scenario wherein RBI has also advised the bankers to strengthen this sustainable finance, increase the green financing, and the banks are now out looking at ways to strengthen their internal capabilities to uh, to do more and more green financing. SIDBI, as you are aware, SIDBI is a development financial institution uh, which is meant for MSMEs, and MSMEs they contribute a significant portion to our GDP, our economy, and also to the employment as a second most uh, employer of the country. So it's a very important sector, and the MSMEs now presently constitute more than 99% of our industries. So this is a very important sector, but this sector is quite vulnerable to the climate change impacts, and that's why SIDBI has taken certain proactive steps to basically green the enterprise ecosystem, and we are working towards that. MSME sector is no doubt very divergent, very heterogeneous. So lot many programs we are launching, and we are also basically having a three-pronged strategy. That one is to directly support the MSME towards greening. Second is to basically undertake certain developmental activities, sensitizing activities, so that besides financing, we can also provide technical inputs and other support so that these MSMEs can take up green projects. Third and most important step is to basically encourage other stakeholders, other banks and financial institutions also to take up green projects through various risk sharing facilities which we are operating in the area of energy efficiency, solid waste management, and we are also coming up with risk sharing facility for electric vehicles, compressed biogas, etc. So various types of risk sharing facilities we will be operating, wherein we are giving guarantees to the banks for the loan sanctioned by them for these projects. Uh, then one more important thing is that now country has taken the agenda to become carbon neutral by 2070, and so SIDBI has to showcase to other financial institutions that this can be done, and that's why we have already started the journey as a first step to basically become carbon neutral, so that ultimately we can look towards becoming net zero. And for that, EKI is helping us to do that. And we expect that by end 2024, we will be becoming carbon neutral. And we are taking effective steps towards that. I will not go much more in detail. My colleague is there with a PPT. He will be telling the House about what various initiatives we are taking. So, and then we will also be taking the question and answers. So, with this, I must again thank EKI and all other participants. Green is a very important agenda for the country, and let us all work together. So, with that, thank you very much.
Thank you, sir. Thank you for your, beside of your time constraint, you have able to make us and give your valuable input. I hope your colleague will be available throughout the program. So later on during the question answer session, specific question addressing to CTP or any other input, he will be able to provide.
Yeah, he will be there.
Yeah,
Santosh
yeah,
will be there.
yeah. I take this opportunity now to introduce our other panelist. We have Ms. Huma Kwazi, Senior Project Officer, Sustainable Finance, CDP. Ms. Huma is a Senior Project Officer and heading the Sustainable Finance vertical of CDP India. Previously, she was with the Ministry of Finance under G20 Sustainable Finance Working Group and has handled India's multilateral and bilateral engagement on that particular subject domain, including climate change and environment. We have also Mr. Anirban Chatterjee, Head of Business Development, Sales and Marketing, India and Middle East, Supply Chain and Product Assurance of DNV. Uh, Anirban is an expert in digital innovation, strategy, sustainable finance, management consulting, and risk management with 1.5 decades of diverse experience in ESG and has an academic qualification of mixed with engineering and post graduation in financial management. Prior to DNV, Anirban has worked with banking sector, specifically Yes Bank, and was responsible for digital strategy and banking. In his previous stint in Bureau Veritas certification, he has handled portfolio of second-party audits and sustainable services for South Asia. And our next panelist will be Mr. Arun Vector, my colleague. He is Senior General Manager of Sustainability Services here in EKI. Arun's areas of expertise are ESG, performance assessment, implementation of green building, green manufacturing concept, and resource efficiency movement. Prior to EKI, he was part of CII, Green Business Center, and has worked with more than 400 companies and by providing technical services to covering multiple sectors in the field of environment and climate change. He is a certified lead auditor, ISO 5001, and energy auditor of BE certification. He is a chemical engineer and postgraduate in finance. So this is our panel today. I like to now invite Ms. Huma to present her understanding on the subject.
Thank you, EKI, for having me as a speaker on the esteemed panel. It is indeed an honor to be a part of this panel and represent CDP India and spread insights of the ethos of the CDP, which lie in disclosing and promoting environmental cautious data by companies, financial institutions, and cities and regions. Going forward, I would like to present a few slides to give an synthesis of the idea behind climate-related disclosures and associated imperatives. I hope my presentation is visible.
Yeah, it is visible.
Okay, so as we all are aware that there's a need for urgent climate action, and the IPCC climate change report of both 2021 and 2022 have underpinned the importance for the same and have reiterated that 1.5 degrees centigrade of warming could be reached as early as 2030 at the current rate of emissions if we do not take measurable actions. Also, the World Economic Forum Global Risk Report has identified extreme weather as a consistent threat to humankind that will have significant and long-lasting impact on the economic growth and prosperity of the nation. Few few of the climate-related risks that emerge and affect the overall economic well-being of the markets and then the nation are, few of them are, climate-related risks are asset impairment that leads to changes in the useful life or fair valuation of the assets in the times to come. Then it also leads to the increased cost or reduced demand for the products and the services, which are not environmentally green. Then provisions and contingent liabilities arising from the fines and penalties through more stringent emission regulations that are occurring across the globe and are also soon happening in India at a fast pace. Also, the changes in the expected credit losses for loans and financial assets is something which also hamper the economic well-being of the banks, companies, and all the nations at large. Nonetheless, if we see transitioning from a positive lens, we'll come to know that there are also immense opportunities that can be leveraged upon, which are growth and innovation through the development of products and services that contribute to climate change and mitigation adaptation, reduced costs through improved energy and resource efficiency, improved reputation of the companies, banks, financial institutions with employees, customers, and other stakeholders, improved resilience to the business disruptions. Now let's dive deep into the concept of materiality, which is very important to understand at this point of time. What do we mean by the word materiality? It is rightly embedded in the TCFD recommendations, which we all know are centered around the risks and opportunities and the governance and the strategy around managing the risks, which are related to climate change, basically. So as we go by the definition of the materiality, it is basically the host of topics that have an impact on an organization's ability to create, preserve, or erode economic, environmental, and social well-being for itself, its stakeholders, and society at large. So the concept of double materiality is embedded in TCFD recommendations, which is really important and interesting, and in the sense considers equally how the organization impacts the environment and how the environment affects the operation of the company or a bank. So these are the climate-related risks for the financial institutions per se. Climate risk manifests its dangers on the financial stability of the ecosystem in two primary and major ways, which are physical risk and transition risk. Physical risk mainly cause direct harm to the assets and disrupt industry or company value chains. And transition risk are basically that arise from the overall shift to the low carbon economy through changes in policy, technology, and market regulations as banks and companies try to adjust towards the low carbon economy. Apart from credit quality, climate risk have also an impact on market and reputational and operational risk of the banks. Reputational impact is something which affects the financial entities more indirectly. Reputational concerns arise when customers financed by the financial institutions carry on business activities which have an adverse environmental impact that leads to the erosion of the reputation of a bank. But the good news is that the financial institutions have started recognizing the threat that climate change poses to their overall well-being. Globally, many investors have already started to move from the firms which generate greater environmental cost or engage in activities which are likely to cause environmental harm in times to come. However, momentum is also being built up in India at a fast pace. Now, let me give you all an overview of what we do at CDP, which is the world's largest environmental data repository, and strive to drive climate action through the power of disclosures. CDP, as I told you, 19,000 plus companies in over 19 countries are reporting to CDP about the environmental footprint on the three distinct questionnaires which are centered around climate change, water security, and forest conservation. 1,100 plus cities, states, and regions share the best practices through CDP. 200 plus global corporate supply chain partners are reporting through the CDP platform. Our network of 680 plus investors and purchasers, which represent over $130 trillion in assets under management, along with the policymakers around the globe, use our data and insights to make better informed decisions which are environmentally cautious. CDP recently announced the alignment with the ISSB. This will be critical in boosting corporate action and accountability, providing financial markets, governments, and regulators with clear comparable data to inform their decision making. And I'm very happy to announce that Mumbai has been featured into the A list of cities this time, and it is the first Asia Pacific city to list under A category. So now let me give you a brief overview of how CDP works for the financial institutions. Financial institutions are signatory to CDP, and they request CDP to urge companies to disclose and provide data on the environmental impacts around TCFD, which is mainly around risk, opportunities, governance, and strategies. So the companies provide the data through reported emissions and things like that to the CDP, and CDP provides the disclosure and data insights back to the investors and lenders. So what do investors and lenders do with our data? They use our CDP disclosure data and insights to make informed decisions around investment and engagement and drive climate action. So now let me tell you about the connect that CDP questionnaires has with the SEBI's business responsibility and sustainability reporting. CDP India conducting a mapping exercise that involved assessing the alignment of SEBI business responsibility and sustainability report with the three CDP thematic questionnaires, namely climate change, water security, and forests. Overall, 65 out of 140 BRSR questions have some kind of overlap with the CDP questionnaires. Though the CDP questionnaire is majorly on the environmental aspect, but the social lens is also embedded in those environmental questions. Alignment of the CDP questionnaire reduces the reporting burden for companies already that are reporting to CDP India. And 67 BSE 200 listed Indian companies reported to CDP in 2020, which increased to 89 in 2021 and further increased to 122 in 2022. And there's only upward trajectory is expected in the years to come. So there's also a link of CDP BRSR report that we did, and I'll paste the link into the chat box after my presentation. Also, in a year when BRSR becomes mandatory, that is this year, 2023, CDP disclosure could align as a capacity building initiative to facilitate BRSR. Our sample in 2023 is aligned to BRSR listed companies. The scope of CDP questionnaire ensures that each aspect of the most pressing global environmental issues like climate change, forests, and water security are comprehensively covered and provides businesses with a pathway to progress to higher levels of environmental stewardship. In addition, other benefits of disclosing to CDP include boosting investor confidence, identifying environmental risks and opportunity, and gaining a competitive edge over non-responders. This is something which is like really important. Okay, so these are the latest key insights from the CDP disclosure data, which are used by investor signatories, banks, financial institutions to base their lending decisions on. So as I told you previously, in 2022, 122 companies reported through CDP India. So 97% have board level oversight of climate related issues, and 80% have the inclusion of at least one board member with competence on climate related issues. This shows that the companies are eagerly embedding the governance aspect of the TCFD into their operations. 58% of the companies use a scenario analysis to inform their strategy, while 52% have a transition plan aligned with the 1.5 degree centigrade pathway. So transition plan, as we all know, are a vital tool to demonstrate to investors and stakeholders that an organization or a company is committed to achieving 1.5 degree pathway and that its business's model will remain relevant and profitable in a net zero economy. The financial impacts reported from climate-related risk by the 122 companies is to the tune of INR 2,842 billion, and the estimated opportunity is around 31,000 billion INR. And this represents a 10 times increase as compared to 2021, mainly because of inclusion of green hydrogen opportunity and clean energy shift as an identified opportunity. The reported total carbon equivalent emissions have been around 1,429 million tons of carbon dioxide, which is an increase of 24% compared to 2021. More Indian companies are working on climate issues with their value chain partners. And 89% in 2022 vis-a-vis 85% in 2021, value chain partners have reported the environmental footprint to 3DP this year. Also, a total of 195 terawatt hours electricity has been consumed by these companies. And out of 195 terawatt, 18 terawatt has been the renewable electricity share. Now let me give you an oversight of the disclosure data for the financial institutions. So out of 122 companies, 11 of them are the financial institutions and banks that report their data. So this data that I'm showing to you right now is the subset of the data that I've showed you in the previous slide. So 3 banks that have reported to CDP India have identified that they undertake transition planning with respect to aligning the country's net zero target, which is a good sign indeed. Banks have indicated that they use climate-related scenario analysis to inform strategy in some or the other way, some in qualitative form, some in quantitative, and some in both the ways. Few banks have also informed us that they plan to have it in the next 2 years, which is a good sign. Gross global scope 1 emissions have been reported to the tune of 87,000, more than 87,000 metric tons by these 11 FIs. And only 1 out of 11 financial institutions has reported emission on the category 15, which is the financed emissions. And the financial impact reported is around 1145 billion INR, and financial opportunity that has been reported is around 1033 billion INR. To our understanding, climate-related financial disclosure data is garnering attention with time. All these information go a long way in helping financial institutions to make lending and investment decisions. Also, as we know, climate crisis is one of the most pressing challenges being faced by the world today. The financial institutions have a critical role in addressing it. While financial institutions themselves may not have a direct emissions from their operations, they have a huge chunk of emissions from the investment portfolio. The investments made by the financial institutions can either contribute to the problem or help solve it, making them a crucial element in fight against the climate change. Since only 1 of the 11 FI has reported emission on category 15, which is financed emissions, this shows a state of poor awareness and unpreparedness in the financial services sector in Indian context, giving rise to alarming highly financial impacts associated with climate-related risk. Engaging banks intensively is vital for shifting capital at the pace and scale required, as well as working together with their clients in the real economy. So the climate-related disclosures from banks and financial institutions. So in this slide, I present few of the potential drivers for the risk and opportunities that has been identified by the banks. So the potential drivers for the risk are climate-linked disasters, often lead to write-offs, asset impairment, as I have also mentioned in the previous slides, and also the early retirement of the existing assets due to policy and regulatory changes. Enhanced emission reporting obligations such as carbon pricing mechanism and the associated cost implication. Limited understanding of the reporting frameworks due to capacity constraint has also been recognized as a potential driver of risk. Substitution of existing products and services with low emission options, inability to attract co-financers and investors due to uncertain risk related to the climate change. Increased stakeholder concerns or the negative stakeholder feedback, among others, have been, and these are the few of the risks that have been identified. Of course, there are others. And the opportunities, few of the opportunities that have been recognized are development of new revenue streams from new emerging environmental markets and products, access to new markets, development and expansion of low emission goods and services, digital transformation, reputational benefits resulting in increased demands for goods and services, which are basically environmentally cautious, development of climate adaptation, resilience, and insurance risk solutions, use of lower emission sources of energy, among others. So with this, I would like to conclude and reiterate the fact that while globally it is much accepted pattern of financial institutions and banks investing in environmentally friendly businesses, however, in India, this narrative is still shaping up. Financial institution community in India has increasingly started to be aware about the lending and investment decisions. Also, at the same time, it is important that financial institutions disclose on the environmental footprint and increase the financing levels for projects aligned to climate change action. RBI's discussion paper on climate risk and sustainable finance is a testament that climate-related disclosures and managing associated risk will become an imperative for the Indian banks in times to come. Hence, the crux of any non-financial reporting framework is to encourage better corporate decision-making, and long-term creation through the use of transparency. Thank you.
Thank you, Ma, for this nice insight of the summary of activities on various funds at your end, CDP, and it gives a good snapshot of the present scenario with the financial institution, particularly one among 11 is are thinking about portfolio for emissions or their impact, and also the opportunity part in your last slides, which may require a lot of quantification to attract the financial institution more, because finance really runs on numbers. Maybe still the linkages is not so overwhelming to people to participate. I now take this opportunity to request Mr. Anirban to take through his presentation and his understanding on the subject.
Thank you, Samrat, and thanks, Huma, for the insightful presentation, and also the previous speaker, Mr. Rajiv. So, as we are talking about financial institutes and their basically contribution on the entire sustainable finance, how we can accelerate together, I thought of kind of sharing a overall overview about the various instruments, what is evolving, currently India and also globally, and what are the key innovative areas of financing as for the transition finance and overall climate finance aspect. So let me share my screen. I have a brief slides deck to present. Let me know, Samrat, if you can see this.
It is visible. Yes, it is visible.
Thank you.
Yeah.
So when it comes to sustainable finance, we have seen in last 3 years the evolving ecosystem of it globally, and primarily if you look at the activities where the sustainable finance, the transition finance, and blended finance, where the basic difference of three are very important for everyone to understand in this ecosystem, how ESG considerations for investment decisions are becoming a prime factor. Green and socially beneficial investment or behavior, which can actually direct financial institutes to be more proactive or vigilant about their impact on society or environment. What are the short, medium, and long-term investment scenarios, and how they can look at debt and equity market products to be aligned with the sustainable finance principles. So over last 1 decade, we have seen, for example, climate bond standard was one of the primary certifiable standards which has emerged, and subsequently international capital market associations have come out with series of principles of green bond, social bond, climate transition finance, or even of the late in last 2-3 years we are seeing a lot of sustainability linked instruments are also getting promoted in the market and then adopted by the financial institutes as well as corporates to look at what are their overall finance need towards achieving their ESG or net zero decarbonization or sustainable development goal. The gamut of overall sustainable finance, if you look at, there is a urgent need that we look at what are the transition finance need for probably the hard to abate sectors, or the sectors where there is a need that immediate financing to accelerate climate adaptation or mitigation, or even in terms of some of the, as my previous speaker also mentioned about some of the transition risk, how that can be mitigated. So these type of instruments are also in the market. When it comes to blended finance, this is another innovative use of financial instruments to look at development funds, philanthropic fund blended with the corporate or other innovative climate fund or ESG fund to look at how large capital flows can be given or directed towards emerging market from the developing world. And then there comes the evolving requirement of impact investment, of how blended finance can be looked at as a catalytic capital, and a lot of private public partnership, which is not very new, but then if they kind of integrate the ESG or the sustainable finance principles, then it can really foster the sustainable development. So if you look at the overall three segment, this primarily consists of, and then the green global debt capital market has overall improved. Asia is not very far from Europe and US markets, and there are a lot of instruments are getting issued by the financial institutes, bank, to look at how much of their debt capital market portfolio is trying to be green or aligned with the sustainable finance or climate finance principles. So the driver behind this are, in many of the cases, the instruments are giving improved returns, changing customer behavior, and then also helping to evolve the regulatory environment. For example, the recent RBI discussion paper, which is also kind of directing the financial institutes to disclose their climate related risk, and then what are the opportunities for transition. Similarly, the government of India, Ministry of Finance are also looking at how they can also regulate some of the industry sectors on the form of various contextualized or localized screening criteria in the form of local taxonomies in line with EU taxonomy. So these type of movement have started for almost now 4 to 5 years, and then we will see more and more capital market alignment with respect to the climate and sustainable finance. So this was little dated, but then if you look at, there is a steady progress when it comes to these instruments, what we have seen. And then close to 2022, there is a $1 trillion US market, which Climate Bond Initiative and Climate Bond Issuance has itself issued such debt. India government has already launched their sovereign grade issuance for the first time and raised a significant capital, which will direct towards our ambitious renewable energy expansion towards the entire country. And then if you look at the portfolio of where, or the green areas, or on the transportation, on the hard to abate sector, the green hydrogen, the biomethane and biomass based activities, green ammonia, a lot of new sectors which are emerging in this field to look at how the capital market can direct fund towards development. And then government in return can also provide incentives for the sector to go for it. If we speak briefly about the various instruments and its effectiveness, we are seeing a lot of nomenclature and jargons about green bonds, blue bonds, social bonds, ESG or ESG linked bonds, sustainability bond or sustainability linked bond. So there are few basic differences of these instruments, and which are actually getting developed in the context of different countries, different market or industry sectors. So blue bond primarily looking at the ocean or the water related stress, water efficiency, community impact or through WASH and other initiatives, how the sustainable water management infrastructure financing can be looked at using this instrument. Social bonds are, to some extent, are more of creating a positive social outcome. SDG linked instrument, rural electrification, various last mile connectivity, housing, MSME, health and development, affordable housing segment, and security is another area. So various banking institutes are coming out with such bonds to look at their effectiveness in the market. Similarly, ESG and more sustainability bonds are more on projects which are having specific KPIs, or the use of proceeds will actually go towards social and environmental co-benefits together. And there are flexibilities which are available given by the principles and guidelines by ICMA. On the other hand, if you look at many of the banks are looking at how they can green their portfolio or investment portfolio. So at the time of various restructuring of the debts or their exposure to a company, they are reaching out to the corporate finance team of corporates and ask that, do you have a sustainability KPIs which I can link with your overall liability exposure to the bank? And then if you perform well, if you meet your performance criteria, we will be able to pass on some pricing benefit. And that way, a lot of KPI linked investment verifications banks have started, and which will in turn actually help bank to green their portfolio, or to some extent look at how they can progress towards alignment of sustainability and ESG or climate related risk in their portfolio. And green bond, which was one of the most issued financial instrument in last 1 decade, in order to basically transition finance, provide transition finance to the renewable energy sector and then other associated sector on the energy transition. And so this was quite successful. And then in India also, we have seen from 2015 the entire ecosystem has started, and on the banking sectors have taken a lot of initiatives to come out with such issuance and transactions. This is one example why from very important actually to look at from the ASEAN countries, because while India has kind of raised the first green bond now, the ASEAN has come out with one of the ASEAN country, Thailand, has come out with a important green, social and sustainability is a kind of a combination of financial instrument, so that they can use the use of proceeds in various land use, energy, water, transportation, waste management projects. And this was quite successful, one of the very anticipated and oversubscribed issuance which has happened 3 years back. If you look at on the social bond, I am going to share a few examples and case study which will actually give you some ideas and how these type of initiatives are happening globally, so that the audience and the banking fraternity who are present here today, they can inspire some ideas from here. So on one of the transport finance company, it was one of the very important case study on the social bond side, that how they can look at the socio-economic outcome of the large logistical sectors, the truck driver, owner, and then MSME, which are associated with the entire logistics sector, small road transport operator, or who are and then the finance company is actually looking at coming out with a multiple social bonds to support this entire ecosystem. And it is also having an kind of impact on the SDGs 8 and 10, and then also how the overall number of enterprise and the number of people in this entire ecosystem get benefits can be an important outcome out of this instrument. So it was actually published globally, one of the Indian transport finance company who has come out with this instruments, and it was become a kind of global case study to scale up such instruments. Similarly, if you look at some of the global case studies on the automotive sector, how automotive sector and the automotive supply chain can reduce their scope 1, 2, 3 emissions, and then using what are the technology transition and the electric vehicle or fleet electrification, or investment in hybrid or fully electric vehicle as actually looked at. So these type of instruments have also come out globally, and then we have supported also in terms of providing the advisory. In the maritime decarbonization, there is another big area which International Maritime Organization is looking at, how the maritime sector, one of the hard to abate sector and shipping, is looking at the reduction of footprint, and it is of course kind of KPI linked, and then it is going to help support the entire energy or fuel switchover from the fossil fuel based to green ammonia or even green hydrogen based shipping. So this type of instruments have also we have seen globally. there was a very important aspect wanted to share, like various multilateral development banks. One example is just given here, like Asian Development Bank, similar to World Bank, IFC, and other multilateral development bank, BRICS Bank, which India is part of, are also looking at supporting the local banking ecosystem or the economic development with this type of various instruments. And then this is one of the various market driver, how multilateral development bank has supported with blended finance or sustainable finance, direct investment or some kind of an offshore issuance in the form of a masala bond, and then they were part of the entire concessional financing activities. Now, another aspect to quickly touch upon on this, what should be the ideal transition scenario. So if you look at for a corporate, or if you look at the asset level, my previous speaker also talked about, but then there has to be a blend between what are the climate related performance target, what are the overall corporate strategy and the investment plan. And then accordingly, the financial institutes can really work backwards, look at what are the benchmark available, whether it is scenario analysis, 2 degree, 1.5 degree, science-based pathway, and then TCFD and other frameworks are giving those direction how the transition financing can be linked with the corporate performance over a period of time. Similarly, at a very asset level, as we were talking about shipping or automotive and any other construction sector is also another big area, which is trying to emit almost 8 to 10% of the global emission, but then at the same time there is a need to green the entire sector. So if you look at in each sectoral aspect at an very asset level, there is, or a project level, how the climate or transition risk or physical risk is being ascertained at the design space, how the planning is being done with respect to building climate resilience, and then what are the basically regulatory or the local site specific requirements which will basically adapt the entire asset or the project towards performance. And then the project management or the financing can be linked with this performance basically. Okay, and in terms of quantified or qualified measurement of the projects. These are again few case studies. I will of course share this slide deck with our EKI team so that it can be shared across. This is another instrument which briefly talked about on the sustainability linked bond. If you look at the KPI driven, it is not linked to a particular asset where the proceeds are going, but then a general purpose use fund is being raised linked with various KPI which could be environmental or social. And at the same time, this could be an independent opinion which is very common for the financial institute to take, and then the very annual verification of the KPI, whether during the bond tenure, whether the performance of those assets or the KPI which the corporates are taking are being adhered, or there is a significant progress. And there has to be a very important materiality while this type of initiatives which we can look at, and the value driver which are there. If you look at the evolvement of this entire scenario, there is a new area emerging which is like using how digital sustainable finance instruments or digital green bonds or other aspects to improve the efficiency of the monitoring, and other projects are being integrated into the overall project methodology and the verification. I will also talk about another aspect of the loan markets, which are most bilateral other than the bond market. Many financial institutes are also looking at their corporate exposure or the corporate banking criteria, and how the sustainability link, the example what I have just given recently, one of the large conglomerate in India has raised almost 1,000 crore plus through a sustainability linked loan for their 2030 kind of targets and how they can meet. So it is between a bank and the corporates to look at how the overall debt exposures or the restructurings are aligned with their sustainability vision or climate or decarbonization or net zero vision. So this is another very important instrument. If you look at another area of stock exchanges or the market regulators, globally sustainable stock exchange initiatives is already there, and then they are looking at how the overall partnerships driven approach can be adopted in basically development of green products and services, greening the financial markets in terms of the large institutional investment as well as retail, and there are specific laid down criteria. So in India, probably the SEBI and other market regulators are also participatory members to the sustainable stock exchange initiatives, and they are also basically driving this entire agenda of green investment. Another very UN-led initiatives which talked about the principle of responsible investment, and then there are 6 principles which direct the investor community, not the banking ecosystem, but the larger investment asset management community, to align their overall portfolio into ESG linked or ESG aligned activities. So this is a very old activity. And then apart from PRI, there is a principle of responsible banking. Indian banking and financial institutes are recently organized a very large engagement with the Indian banking ecosystem to organize capacity building program on principle of responsible banking and investment, where they involve the board level people, the subsequent credit risk managers, the head of the underwriter, as well as the relationship manager, because ultimately we need to build capacity at each and every banking ecosystem, so that the understanding is better, and then banks can serve in a greater manner when it comes to responsible investment. I am not going to touch much upon the climate risk part because my previous year has already talked about it. But then if you look at the investors assurance, there is a equity investment, there is a listed equities, bonds and loans. Across the areas, there is a requirement that the upgradation of the energy transition and alignment with respect to the sustainable development goals are being evaluated. And there are ISO standards. ISO has recently come out with also the climate finance standard, and there are other standards which actually helps investment and the reporting of the financial activities which is related to primarily climate change. I briefly talked about the green digital finance, which is also kind of a emerging area, and then how efficiencies can be done. World Bank has in 2-3 years back has done a first publicly offered blockchain bond, and there are a lot of startups ecosystem which are currently working on this entire green digital finance. And then in India also there we might expect similar digital finance instruments as well. So briefly, what we do, we are into ESG services, assessment and reporting when it comes to ESG risk management, due diligence, rating improvement, data assurance, this providing SPOs and governance, and then impact assessment and alignment with respect to evaluation of the climate risk and the scenario analysis. So this is how we are, DNV is supporting the entire ecosystem globally, and especially in emerging markets like India, Middle East, and Southeast Asia. So that's it from my side. Any question? And over to the Samrat. I will.
Thank you, Anirban. Thank you for this nice presentation. I will be having a lot of queries to it, but it may not be the right forum. We don't have so much of time. Yeah. So I just want to invite Mr. Santosh, the colleague from SIDBI, who wants to present on behalf of Rajiv Kumar few slides on today. Hello, Mr. Santosh. Welcome.
Hello, sir. Sir, is it audible?
Yeah, you are perfectly audible.
Okay. So I'll go with the presentation.
Yeah.
Is it my screen is visible, sir?
Yet not. Yeah.
I think.
Yes, it is visible now.
Thank you. So I thank EKA for giving the opportunity for SIDBI to present in this platform. So I will be giving a short presentation on SIDBI's green financing and development initiatives. So we here at Green Climate Finance Vertical, sitting at Delhi. So we are the head office department where we devise the policies and the guidelines for and also the financial products for green finance in SIDBI. So first, SIDBI is an SIDBI Small Industries Development Bank of India, established under an Act of Parliament in 1990, and we are the principal financial institution for engaged in this promotion, financing, and development of the MSME sector. Our mandate is to promote, finance, and develop the MSME sector, and coordination of various functional activities of various institutions engaged in similar activities. So these are the entire bucket of services what SIDBI provides. One is this fund of fund support, where SIDBI along with the SIDBI venture capital, our associate concern, we provide the venture capital funds, and SIDBI also provide financial and development activities and to support entrepreneurs. And actually, we are the trusted nodal agency for MSME oriented schemes of Government of India. And mainly SIDBI started with a refinancing institution like indirect lending through. So we finance, like we provide funds to the banks, the government funds to the banks, SFPs, NBFCs, MFIs, and new age fintech. So till now also our major portfolio is in direct financing, which is contributing to overall 90% of our portfolio, and the direct lending. So to outreach to the MSMEs, so we started direct lending and we provide direct lending also. And as all we know that there is a global demand and national commitments, and we all know that the climate change is one of the biggest problem. And as a COP26 commitments, there is a strong commitment by India that net zero by 2070, and we should need to shift from clean energy to clean energy and non-fossil fuels, and there should be a 45% reduction in carbon intensity by 2030, and our carbon neutral and net zero commitments to the world. So, and recently these all things were approved by Union government. And so in the recent budget speech also, there is the recent policy pushes on hydrogen mission, but there are other like climate action, clean energy, solar, e-mobility, battery, waste management, and all these aspects which are the green spectrum is being pushed by our government to take actions. And recently there is a RBI have released a discussion paper on climate risk and sustainable finance. So where they suggest appropriate framework to the regulated entities for managing and addressing the climate-related risks. And this paper actually suggests to set the voluntary targets for green finance. As we said, we have been already more than a decade we are working on it, and I can probably say that we are the front runners in climate financing and the green financing forum. And SEBI also recently made like business responsibility and sustainability reporting mandatory for top 1,000 listed entities. So soon it may become mandatory for all the industries, including MSMEs. So the cumulative investment, there is a study that like 10.1 trillion US dollars, around 84,000 crores of investment is required to decarbonize the Indian power, industrial, and transport sectors. So this is another CEW study, and this is the investment maybe required to achieve the net zero emissions by 2070. So I'll come quickly. I will tell you this is our focus area in green, that energy efficiency and e-mobility, renewable energy, green buildings, waste management, and projects directly contributing to the positive impact on the environment, climate change, and then waste water treatments and any type of green and sustainable solution, we finance it. So this is our journey. So you all know that 2002 Bureau of Energy Efficiency has given the Energy Conservation Act. So we have started this MSME financing and development, where few green features have been incorporated, and started with that in 2005, and later in 2007 we have borrowed funds from multilateral agencies like JICA, KfW, AFD, and also World Bank. And we started like financing energy efficiency missions. Like we started with financing like equipment financing. So we have prepared a detailed list of equipments, latest technologies, where our credit officers, it will be easier for our credit officers to if a promoter approaches, they just go through this list, and they will see what are the equipments they have approached for, and they will also explain the benefits of that energy saving. So we started like that, so like financing energy efficiency equipment, and later like a credit plus approach, what we have did with our FIM project, like financing energy efficiency at Amazon. This is one of the World Bank JEF project. So we have implemented that in more than 25 clusters in India. So what we have did, it was like end-to-end energy efficiency we have provided. Like we have asked them, we have required the technical energy auditors, BEM panel auditors, and we have asked them to go for walkthrough audits in the clusters. And so after walkthrough audits, so the potential MSM units have been selected, where the energy intensive MSM unit has been selected, where the immediate energy savings can be achieved, and which can improve the bottom line of the MSMEs. So those things have been done, and if an investment grade detailed project report has been prepared. So these more than I think more than 1,000 audits have been done in that project. So those detailed audit reports with the willingness of the MSME units, we have financed also, and they have taken finance from their bankers also. So later, like we have formed a consistent lending. 2007 also with the lineup produced from foreign agencies. So the consistent lending only can change or initiate the market in this green financing. So we have also did a blended finance, like a blending product we have did in 2014, where end-to-end, and we call that scheme it as FORE scheme, where that is end-to-end energy efficiency scheme. It's a revolving fund. So we have brought our funds and also a grant, a small, around 28% of the grant from JEF. And we have created a small product, like 100 crore portfolio initiative. Like we have created 100 crore funds. And we have financed more than 100 units in that. And this fund we have revolved, and now it is aggregated to the tune of around more than 100,000 crores. We have our bank have allotted under this FORE financing scheme, and we are still doing it. So, and our GM has already referred that we have a lot of risk sharing facilities. So everything we started with energy efficiency in the MSMEs. So this partial risk sharing facility, it is also for the energy efficiency promotion in MSMEs, like it is promoting an ESCO market in the MSME sector. So there where the ESCO implemented projects will be guaranteed to the tune of 75% of the loan. So that is one of the risk sharing facility. I will come in detail later. And this is the journey, and now we have the dedicated vertical for green climate finance vertical. Last year we have launched this Mission 1000 solar financing solar rooftop project in November, and now we could assist around 570 crore of solar rooftop investments in MSMEs in a short span of 5 months. And And like we have also launched a product grid, we call it as green inclusivity. So working in all the clusters in India, MSME clusters. So this is way forward and upscaling where we have negotiating for more risk sharing facilities for all different green segments like EV, CBG, MSW. So these are the important schemes and initiatives, and just I will quickly go through the the silent features of the schemes. These are the four green schemes we operate in SIDBI, like end-to-end energy efficiency for refinancing, and Express EGPS loan, we call it as loan scheme. It is Express Green Power for Sustainability, and there is one scheme like Green Finance Scheme, where we finance the entire bucket of entire spectrum of green projects under this green financing scheme. And there is one TIPAC SIDBI. This is a government supported and government and services like TIPAC SIDBI Technology Innovation Program. This is for innovative projects, first of its kind projects in India and the world. We support those projects. And quickly going through the scheme, it's like this is the, under the scheme, the per project we the quantum of assistance is maximum is ₹5 crore, and we have temporarily increased that to 7.5 crore up to March 31st, and we will review it. And the repayment period, since all the green projects or energy efficiency projects will have a shorter payback period, so we kept it as 5 years, and 7 years on case-to-case basis. Like renewable energy projects have higher repayment period required for those kind of projects, so we have kept 7 years for on case-to-case basis. And the interest rate is actually repo linked and it's floating, and the current range is like 7 to 8.1%. And the type of projects under this CODI scheme, we assist like energy efficiency, solar rooftop or governmental projects for captive customers. So the MSMEs which they want to go for a solar project for their captive use, so that only is funded under this CODI transit scheme. And also the energy efficiency part is that machinery, the energy efficiency machinery or the energy efficiency processes or the technologies that they want to invest, so they can go with it. And eligible borrowers are MSMEs in both manufacturing and service sector, including education institutions and hospitals. And this is here, the model is like 100% financing. So we, if an MSME is coming with an invest, we finance the 100%, and we take a minimum 28% cash collateral for that. So cash collateral will be kept by the MSME or the borrower with SIDBI, and that is actually it will earn interest. So it is quarterly compounding. Will be so though that entire along with the interest, the FD will be provided to the MSMEs upon closure. So that is the simplified approach what we are following in our SIDBI. Not only for this scheme, we have other schemes also similarly. And here it is particularly for this green project. And this is eligible simpler dispensation when the unit is having at least 3 years profitable track record for the last 3 years. So suppose if there is no the track record is not profitable, then they will go with the detailed appraisal. In detailed appraisal mode, we'll go with units in existence for less than 3 years also. So and at least 1 full year operations is tracked. Here the minimum promoter contribution is 10%, and we finance 90% of the project. So this is one of this EGPS scheme is also a variant of CODI financing scheme. It's a variant of CODI financing scheme. Here, why we have created the scheme is like to quicker sanctions within 3 to 4 days at the maximum. So what is the difference between our general schemes and this one? So when an MSME, we made all the system, like our entire SIDBI system is digitalized till disbursement. So so application is online mode. Here in this Express scheme, upon completion of application, there will be a fit score generated by the system, and the rule engine has been defined behind that. So that fit score provides the in principle. So up to rank fit 6, we finance, and that rank will go to the branches, and they will immediately contact the borrower. Will have a KYC and pre-sanction visit, and the sanction will be done quicker. So here the maximum loan we provide is 1 crore, and minimum is 5 lakh. So here the thing is like 25% of the turnover we maximum finance under this scheme. So and the maximum exposure is 2 crore. So again the same minimum maximum 5 years, including here the repayment period is only up to 5 years and including more than 6 months. The same interest rate we have in corporate. So since it was a blended product, so we have a interest rate which is very less than a commercial bank, you can say. And here all types of projects like capex circuit, diesel, petrol, or if you want to shift to your gas pipeline projects in Delhi, you all know that the DG sets has been banned and it is to be moved to gas-based generators. So MSME units are finding difficult to find a product where this can be financed. So we have devised mainly for this product only. Later we have also included all this like solar rooftops and other projects which result direct positive impact in the environment. So like waste management, solar heating, drying also included under this product. So and this is the green financing scheme. Earlier I have shown you the key sectors where green sectors where CPP is addressing. So this is the scheme where we finance both the MSMEs in both supply and demand side. So here the quantum of financial assistance to a single project is 20 crore. And for an aggregator, if an aggregator who is an MSME, who brings a number of projects, 2 or 3 projects, or a cluster of projects where it goes up to 50 crore, also we finance under the scheme. So here also we have kept a minimum promoter contribution of 10% and the 90% we finance under the scheme. Here the maximum repayment period is 10 years. And the interest rate is repo linked and it is 8.2 to 10%. This is the rate. And here also both existing and greenfield winners we assist, and RESCOs, ESCOs, EPC companies and vendors or any MSMEs in both supply and demand side of green value chain. And we have a risk sharing support for these green projects, and that can also be accessed. So these are the activities covered under this green finance schemes. Already I have shown you. And I told you about one government of India's funded product, which is 30 crore fund has been given by Department of Science and Technology to SIDBI to manage the fund. Manage the fund where here the maximum assistance can be given up to 2 crore and the interest rate is maximum 5%. And it is fixed per annum. So these are here the projects. What are the projects can be assisted is like, for example, if it crosses this R&D stage and the prototype is ready and it is ready for commercialization. So those types of projects are assisted under this STRIGEL scheme. Here we like it is a scheme to promote innovation, upscaling, and demonstration commercialization of new and innovative technologies. Here the word innovation. So here the technology will be vetted by TIFAC, a pool of scientists. So here more than 300 projects have come till date, but only 30 assistants have been provided. The rejection rate is more than 90% under the scheme. So here we cover all the expenditures required for a project to commercialize, like capital expenditure, plant machinery, testing and quality, intangibles like patents, copyrights, or the fees required for licensing, marketing, and brand building. So expenses, working capital margin, so all these expenses. So is being financed in the scheme. So eligibility is all Indian MSME units or startups are also eligible. So coming to this partial risk sharing facility, this is the first risk sharing facility we have started in 2014, I think so. It's a this is actually, I told you already, this is a risk sharing mechanism for ESCO based funding. So in MSMEs, there are a lot of energy intensive MSMEs where they're struggling with the energy leakages and all this. So to tap and improve their bottom line. So this product we have launched, this risk sharing mechanism, where the project the ESCO involvement is mandatory under this. So the unit should undergo a detailed energy audit, and the ESCOs will prepare the DPRs, and also the energy service performance contract will be executed between them and the host entities. So those kind of projects we guarantee to the maximum to the 78% of the loan amount. So a single project of minimum 10 lakhs and maximum 15 crore loan amount projects can be guaranteed here. And the maximum guarantee exposure to a single host, the MSME unit, and if you see a guaranteed model or a risk saving model, a share saving model. So single host or ESCO, we maximum guarantee exposure is 45 crore. And for a grade 5 ESCO, if it's involved, its maximum exposure is 40 crore. So guarantee tenure is generally 5 years, and recently we have increased that up to 7 years. And the eligibility is either the borrower, either host, borrower should be either a host or an ESCO, should be the MSME enterprise. Any one side of the chain should be an MSME unit. Then the project is eligible for the guarantee. And 70% of the project should be towards the energy efficiency investment. And non-BE empaneled ESCOs are also allowed, subject to grading by the rating agencies like ICRA, CRISIL, SMERA, QTEX. And these are the projects.
So Santosh,
Yeah.
Samrat here. For the sake of time, if you can conclude quickly.
Yeah, it's going to.
Yeah.
So these are the sectors we have already guaranteed. So here there is a guarantee fee. So year on year, it's maximum it's 1% on the outstanding amount. It's a big charge. So and there are other risk sharing facilities. We have recently launched for municipal solid waste project management projects. So where we guarantee up to 60% of the project cost, and maximum 4 crore amount is being guaranteed. So, and also we are working with World Bank for compressed biogas and EV project guarantee mechanism. So this is a project grid which is called Green Inclusivity. So we again started to penetrating into the MSME clusters for providing the green solutions. So we have started now, and we have an ambitious target to go around 100 MSME clusters in the long and another 5 years. So and as an institution also, we have decided to go carbon neutral, and EKS is helping on that, and we have decided to reduce the carbon footprint in a phased manner, and eventually we will become carbon neutral by 2024, and net zero is the next step. So I think thank you. So I request all the banks and financial institutions over here. So we should take small steps to green the entire industrial ecosystem or financing ecosystem in India. So thank you for so much for that.
Thank you, Mr. Santosh, for this elaborate presentation. I now request Arun to take the floor and carry on the discussion. And then you may like to also take up the question answer session at the end of the event. You can coordinate that. Thank you everyone for this very energetic participation. For some previous decided work, I have to leave now. So please excuse me. My colleague Arun will now discuss on the subject and coordinate with the event. Thank you.
Thank you.
Thank you. Thank you very much, Samrat.
Yeah.
And coming to the next topic, the ESG journey for financial institutions. So we'll be presenting you with a very brief presentation. Just sharing. So my screen is visible?
Yes.
Thank you very much. So before I go into slides, I have a very exhaustive presentation made for the audience, and it will be a good teaser for you to understand what should be banks and financial institutions should be doing in terms of climate change, addressing the climate change, and then the journey they have to undergo to address the ESG issues. Before I start with my presentation, I would like to bring a very strong point here. In fact, a statement here. ESG and sustainability, they are used interchangeably, and that's going to be the next revolution that's happening across the world. And this is my statement. I have a valid reason for that, and maybe I request all the audience to think about it. We all know that all economic activities, which includes government, industry, and people, they all account for internal costs. And while we calculate our profit and loss statements, or while we see what value we have added, we all account for internal costs. But when the topic of environmental degradation or the climate change impact or the social impacts, everything is external. Everything is seen as an external activity, and these costs are external costs, which I would say these costs are ignored costs. If we continue to ignore these costs for a long time, either it is a market or a business or a government cannot sustain, it's bound to fail. So that's the trend happening in the market. All the external costs are being internalized in terms of by the ways of rules and regulations put by government, or in terms of taxes, or through market-based mechanisms. These externalities are being internalized, and these costs are going to be borne by government or industry, or at last the consumers, by us. We are the one who are going to pay for it. And with respect to financial institutions, so that's why ESG is going to become the next revolution for the whole world. And coming to today's agenda, financial institutions and banks, they are a very key stakeholder in terms of allocating the capital. And while they do this activity of capital allocation, they cannot ignore the costs or the damage that is happening to the environment or to our society. And if they ignore, and if their capital allocation will be inefficient, and it's also bound to fail. And if they fail, markets will fail. So that's the underlying statement. So my presentation will cover some basics, and we are going to provide you some overall landscape about the ESG and the climate issues around financial institutions and banks, and what should banks and financial institutions to do to address while they undergo the journey towards climate and addressing climate and ESG issues. So these are the things we are going to cover. I'll be quickly running through the slides. Maybe I will not be presenting all the slides. We'll pitch some important points to you, some key things which institutions should understand. Everybody is aware about ESG, because ESG is the term which is popular among the investor community, and financial institutions are including ESG in their portfolios. There is a rising level of awareness among investors. India, at a country level, the assets under management, ESG assets, are surging multifold compared to previous 3-4 years. And even ESG indices are outperforming their market indices. So there's a great momentum. And this momentum all started in the year 2006. And it's influenced by UN movement responsible for responsible investment. So these are the 6 principles for responsible investment. This is a UN-based initiative, and all the stakeholders of the financial community are joining this movement. And if you see that the present state, over 5,000 signatories are there to the UNPRI, and from over 60 countries, different types of asset owners, investment managers, service providers, banks are part of this. And after signing these principles, they are expected to report on the progress towards implementing these principles. And also, this initiative provides a lot of guidance and resource to all the signatories to address the ESG issues. So I hope many of the Indian banks and financial institutions are also part of UNPRI. If not, this is a very good initiative you can join. And to begin with ESG, everybody know what ESG stands for. And a key thing to understand here, these are non-financial considerations that should go into your business strategy and decision making, because it can result in financial consequences. In this slide, we have given few examples of what are the examples for some of the environmental issues, social issues, and governance issues. These are some sample elements, and everyone should be disclosing this ESG information, especially by banks and financial institutions, because investors are using this information to measure how resilient will be any organization to manage their ESG issues, and that's going to help them to provide improved access to capital, and then complying with the regulatory changes, and then strengthening their corporate performance, and then enhancing their reputation and engagement with stakeholders. And so ESG has to be a very key strategy for financial institutions, because a lot of movements are happening in terms of new legislations across the world, and financial institutions vastly differ in their readiness for this transition. And slowly we are seeing the momentum happening. People are now talking about aligning their disclosures by some global frameworks like TCFD and GRI. So this ESG strategy is becoming very crucial for financial institutions. So these are some of the examples of environmental criteria. Typically, an organization should be focusing on various of these environmental criteria, and then strengthen their performance on improving them. Similarly, examples of some social criteria. So financial institutions should also see these as a key issue, and they need to improve on these performance. Similarly, governance is another major area. Some of the examples have been presented here. So if you see the regulatory standard, one good example is from Europe, like we know about green taxonomy, which is a very clearly defines what is a sustainable economic activity and what is not. And it is acting as a Bible for the entire corporate and financial institution community, where the SFTR rules have been mandated for all asset managers, pension funds, and insurers. They should disclose their ESG risks associated with their investment decisions. And similarly, funds will have to disclose the information on the ESG risks for the investors. Similarly, there are directives being mandated for corporates. So they have to report on their ESG performance through corporate sustainability reporting directive. So these kind of mandates are being evolving worldwide. Similarly, in India also, we could see that BRSR has been mandated, and many financial institutions also would be a part of it, where they have to mandatorily report their ESG disclosure. RBI also had came up with a discussion paper on how all the regulated entities should see climate risk, and then focus on sustainable financing. So these are some of the recommendations given by them. Firsthand, they should have a board level committee comprising experts from sustainability and risk domain to address climate related issues and take strategic decisions. And similarly, climate risk should also be a part of the due diligence process of all the regulated entities. And all have been advised to align themselves with climate related disclosure recommendations. So these are some of the recommendations or suggestions that have been discussed in the paper, recent paper by RBI. Also, banks should consider converting their branches to green branches. A lot of activity has to be done in terms of capacity building, and financial institutions are going to play a major role in helping India to reach our net zero target by 2070. But the real challenge is we should ask this question whether we are ready to address all their issues, and then how difficult are these things to quantify or address. That's the challenge. A lot of demand is coming from almost all the stakeholders. It is from regulators and then from supply chain partners, from customers, communities, employees. All are demanding. So it is more or less becoming like a mandate. So now we'd like to throw some light on some of the ESG reporting frameworks that's being prevalently used by corporates and financial institutions. There are voluntary frameworks like GRI, Global Reporting Initiative, and there are mandatory frameworks like BRSR, which has been introduced recently by SEBI. And as we mentioned earlier, there are Corporate Sustainability Reporting Directive with the EU. That's one example of regulatory framework. And on the left-hand side, you could see all the types of voluntary frameworks. So financial institutions can take up these type of frameworks, disclose their ESG performance, and then align it to one or more of these such kind of frameworks. And so these are giving more details into what is GRI, and then what are these kind of voluntary and mandatory standards. So they've given you some material. Maybe you can later have a look at it. Because we'd like to throw some light on BRSR because that's becoming a mandate now. BRSR is a recent initiative by SEBI, which has issued a circular in 2021. And they have given a proper format for ESG disclosure for corporates. And top 1,000 listed companies have been requested to voluntarily disclose for the FY 22-23. For FY22 and mandatory for FY23. So now coming to this framework, this particular format has 3 sections. One is the general disclosures and asking some general information about the company. Secondly, how the environmental and social issues are being managed, and what are the processes and what are the disclosure mechanisms that are placed. So those kind of information have to be provided in section B. And in section C, there are principle-wise performance disclosures. There are some essential indicators, and there are some leadership indicators which are not mandatory, but essential indicators are mandatory to be reported. So this is a basic structure of BRSR format. So these are some of the information which we have to provide under each section. This is a graph. This is a table just showing how BRSR is compared with all other frameworks, how it is addressing different industry types, and what is the scope of the information being reported. And if you see that BRSR has a lot of alignment with the GRI and other standards, while disclosures frameworks like TCFD or CDP is more inclined to climate or some specific environmental criteria. And if you see SASB framework is industry specific, which is presently not which is presently missing in the BRSR framework. And these are the alignment scores. You can see that overall, if you see compared to the GRI framework, BRSR is almost overlapping almost 94%. Considering both the essential and leadership indicators. And some basics we have tried to give here. So in a nutshell, this is the roadmap, what we propose to any kind of financial institution. You have to see yourself in this road where you're lying. This is the entire journey, ESG journey we suggest for any kind of a corporate. First, we should see ourselves whether we have included ESG in our business strategy, and then whether we have proper governance frameworks, whether we have management frameworks, how we are going to govern and manage the ESG issues, establishing proper policies, and then allocating right resources, and then systems for monitoring. So these are the basics to start with. And then we also need to do a kind of a materiality assessment. We should be selecting a disclosure framework. We should be identifying the key material issues, which is priority to the stakeholders, and then which is highly priority to our company or our institution, and then identify the ESG issues which are material to the organization. And then we need to establish indicators and targets, and then accordingly devise our ESG improvement programs. And we need to ensure that we rightly implement our programs, and then follow our action plans. And then finally, at the end, the companies need to disclose their performance. So key thing here is you should be understanding where you are right now and start acting on this journey. Then part 2 of my presentation is how banks and financial institutions should be addressing the climate change issue. So there are a cluster of initiatives present for the financial institution community right now. These initiatives are of different types. Some of the initiatives are high-level commitments to act to address climate change. Some initiatives are towards measuring the emissions, financed emissions. Some initiatives are focused on conducting a scenario analysis and then focusing on the strategy of financial institutions. Some of the initiatives are are focusing on target setting. What kind of targets financial institutions should be taking to address climate issues, and some initiatives are focused on enabling action, taking action, and then some initiatives like CDP for financial services questionnaire is focused on reporting. Similarly, TCFD framework is also focused on the reporting part. So there are many types of initiatives. So we should be very clear what initiative we should be part of and how it's going to help us based on the activity we do. First thing to start for any kind of a financial institution is to account your greenhouse gas emissions. That is going to help you meet multiple business goals. Once you account your greenhouse gas emissions and report it, it is going to create transparency for your stakeholders. It is going to help you set your business goals on how you can manage the climate-related risks, both physical risks and transition risks. And based on that, you can develop climate-friendly financial products. And finally, you can align yourself with the global goals of achieving net zero. So this is how measurement of the financed emissions or the greenhouse gas emissions within your institutions is going to help you out. And there are many standards which can help for a financial institution to account the greenhouse gas inventory. There are GG protocol standards, there are value chain standards, and especially for the financial sector, there is the GG standard, PCAF standard for monitoring the financed emissions, and there are ISO standards are also there, and there are verification standards for claiming carbon neutrality. So these are the standards which is going to help in terms of accounting the greenhouse gas emissions. Coming from the financial sector point of view, like measuring finance emissions is going to play a very key role. Like already in the first presentation, Uma mentioned that many of the Indian banks are monitoring their operational emissions, but not their emissions related to the financing activities. So the best starting point is here. They need to understand their finance emissions, and this particular standard is a standard for the financial institution. This is in concurrence with GHG protocol and also meeting the requirements of the value chain accounting standard as well, and especially focusing on the category 15 of investment and financing activities. And this is the standard. This is PCAF standard, is Partnership for Carbon Accounting Financials, and then they work together to develop and implement a harmonized approach to assess and disclose the GHG emissions associated with the loans and investments. And this has a lot of synergy with all the global activities that are happening. For example, it has a good synergy with SBTi initiative, CDP, and UN, all the UN programs. So this standard is written primarily for financial institutions that wish to measure and disclose the GHG emissions associated with their loans and investments. It can be commercial banks, investment banks, development banks, it can be asset owners or managers, and it can be insurance companies. Already more than 264 financial institutions are already taking action. You can visit this website and see how they are actually accounting and reporting their financed emissions. And so for addressing this climate change issue, what a bank or financial institution should do, they should understand the nuances in this, and then they have to have a well-defined climate roadmap. They should be allocating the right resources, and then also coming out with climate financing products. And similarly, they have to fasten the pace of the transformation. They have to build a lot of capacity. They have to continuously track and then evaluate where do they stand. So a high plan is the need of the hour. And so this is a small roadmap what we would like to present for financial institutions. They have to reduce their carbon footprint in a phased manner. At least in near term, they should be setting a carbon neutrality goal in the next 2 to 3 years. And in the long term, they should be striving to achieve net zero by 2050. The starting point, as we mentioned earlier, is to prepare a robust carbon footprint. They're covering scope 1, scope 2, and scope 3 emission categories, and more importantly, their portfolio emissions. And once they have done that, they have to develop strategies and roadmap on how they can achieve these targets and ultimately net zero in a cost-effective manner. So that these are some of the roadmaps, some of the activities we suggest for financial institutions. And it's also very important for us to understand what is the difference between carbon neutrality and net zero emissions. Carbon neutrality can be a term goal where companies reduce the carbon emissions through their internal measures, and then balance emissions they will compensate by using market-based instruments like carbon offsets. And it should be a target for a very good target for financial institutions for them to achieve in near term. But in long term, all of them should be focused on net zero, at least to achieve net zero by 2050. The SBTi provides the criteria of how corporates can achieve net zero by 2050. And if at all there is any residual emissions, these emissions needs to be removed through permanent measures or permanent offsets, which actually removes carbon from the atmosphere, like forestry or carbon capture and any other technology. So here there is a lot of focus on actual reductions, and this is also going to be supported with passive measures that will be happening at the country level, but by the actions of the government. So it's relatively tougher to achieve, and it's a long-term goal. So companies need to understand this difference and set their goals accordingly. And so for this roadmap, which is just for achieving net zero. For achieving net zero, definitely you need to measure and disclose your financed emissions, the investments and the loans part. And then SBTs can give you a very good guidance. Science-Based Target Initiative can give a very good guidance on how you can set these net zero goals for your financed emissions. And then based on that, we can design our strategy and how we can reach that, and plan our action plans to achieve our targets. So this is a broad suggestion for aligning yourself with the Paris Agreement goals on achieving net zero by 2050. So science-based target, banks and financial institutions can report to CDP through CDP platform, and also they can set their goals for achieving net zero through SBTi mechanism. Right now, SBTi allows financial institutions to set near-term targets, and it is also working with a standard of how they can achieve net zero goals. Maybe in 2023, that standard will be out. But right now, using SBTi, financial institutions can set near-term science-based targets. So that's how this particular initiative can help you. The different type of financing activities are being done by the community, like corporate finance. It can be project finance or consumer finance. And so definitely there are a lot of these activities are either going to generate emissions or remove emissions, or even if it can avoid emissions. So all our capital allocation activities should focus on how we are going to remove the emissions through our finance activities or avoid these emissions, and how we are going to decarbonize our portfolio. So, and there can be various metrics you can use to measure these emissions. It can be in terms of absolute emissions, or it can be in terms of intensity emissions, if it's a growing organization. Or if you're going to understand your portfolio exposure to some specific sector, we can use weighted average method as well. These are some of the examples of metrics that can be used. These are some of the various types of asset classes as per the PCAP standard, and some ways and means how you can calculate your financed emissions we have shown here. Maybe we'll give you this presentation. You can have a look at it. One thing I just wanted to show as a case study here is how a bank has really reported their loan book financed emissions. This is an example of Dash Bank. You can see from this table that Dash Bank has a loan exposure of 476 billion euros, and out of that, 104 billion euros is their corporate loan exposure. And this against this, they have tried to analyze in each and every sector what's their exposure, and you will find that almost 68% of the total emissions is coming from just 16% of their corporate lending, and then overall lend if they compare it for the overall lending, it's only 3.6%. So this can really help you to identify what should be your action plan and where it should be, like which other sectors you need to address. So that's how measuring finance emissions are going to help a bank in planning their activity and then align themselves towards net zero goals. Similarly, this is again an example from a development bank based out of Netherlands, how they have analyzed the absolute emissions coming from their financial activities for different sectors. You can again see here a lot of emissions are coming through from the energy sector and also through the other giving money to other financial institutions. So this is how measuring finance emissions is going to help you to set your targets and align yourselves towards net zero goals. So this I have already mentioned. SBTi finance net zero standard is under development process, and then hopefully this will be launched soon. There's an alliance for net zero banking. Banks can also again this is an UN convent initiative, and then banks can again join this commitment and then pledge to become net zero by 2050. This is a very ambitious commitment, and it's again based on SBTi standards and criteria. Overall, this is a roadmap what we suggest to any bank or financial institutions. Again, very important is that whether we have the right policies or strategy in place. Similar to ESG, we should have a governance framework, management framework. Banks should also identify what are the risks they're exposed to and what are the opportunities available for them. And then they should start measuring their financed emissions, set baselines, and then set targets, achieve carbon neutrality in the near term, plan the long-term roadmap, how they can achieve net zero. It will be very good if they also have follow a carbon pricing mechanism, and very importantly, how they are engaging with the customers and all of the stakeholders, and going forward, implementing the action plans. And then they should be also disclosing, aligned to some global framework or through some platforms like CDP, and then join some of the global initiatives that's going to provide or support them in their ultimate goal. So this is a roadmap we suggest for any type of financial institution, and you just make a self-analysis with where you are and then where you should be moving forward. And so these are some of the offerings which we can give for financial institutions, similar to we are working with SIDBI. We can help you to assess your carbon emissions from your lending portfolios, conduct risk analysis, and then any kind of ESG disclosure if you're wanting to do. That also IKEA is ready to offer you. So in the roadmap, in the both the climate and the ESG roadmap, wherever you need help, IKEA will be able to offer you a solution. And please, I would urge everyone to understand this need and act. So thank you very much. So this is our team, IKEA, at our offices headquartered of Indore, and this is our entire team here. So thank you very much for giving me this opportunity. We hope this presentation was useful to you, and so we are now open to the question and answer sessions.
Thanks, Arun. Thanks for the wonderful insights. Thanks to all the esteemed panelists for a thought-provoking, insightful, and an enriching session. So we have some questions from the participants. Respecting the time, we have 10 minutes time. So we'll just quickly touch upon the key questions. So the one is from Mohsin Iqbal, and I would want Huma followed by Arun to give your comments on that. So, what are the other frameworks apart from CDP or the other disclosure platforms where Indian corporates, banks, and financial institutions in particular are looking at for their sustainability related disclosures? And what are the other modes of sustainability related disclosures which are being adopted by Indian financial institutions?
Hmm. Okay. Thank you for that question. I mean, yes, of course, as Arun also mentioned in his presentation, which was very beautifully and insightful. The companies and banks, they report through, there are a host of international and voluntary reporting frameworks like GRI, SASB, UNEP, PRI, Principle of Responsible Investing, apart from CDP. But yes, so, but I'm not sure that if these companies that report to CDP are also simultaneously at the same time reporting to these reporting frameworks. That I'm not sure about. But yes, they are host of voluntary reporting framework across globe. And if you talk about the national context, then there's of course BRSR, which requires top 1,000 listed companies to report on a mandatory basis on the ESG footprint. So with this, thank you.
Thanks, Uma. Arun, you want to add anything on the modes of sustainability disclosures by companies?
Yeah, my suggestion would be to because climate is something different where Indian banks, especially banks in India, they have not understood this subject. So for them, best thing to start understand this subject and then improve upon it would be to start reporting to CDP, because that's a very good platform where they will be getting their scores and they can benchmark with what others are doing, not only within the country but also outside the country. So with respect to climate change, I would say CDP would be the gold standard for any kind of a financial institution to start reporting and working on addressing the climate change. Of course, ESG reporting is being widely practiced by many of the institutions in India, and there are frameworks available. Now, BRSR has become a mandate. Most of the banks have been using the GRI framework, and now they have to just map it to the BRSR requirement, and then they disclose it. So these are two points, but CDP would be a very apt platform to start their climate journey.
Thank you, Arun, for the acknowledgement.
Yeah.
Wonderful. So we have another question from Rajesh Kumar, and I would want quick comments from Anirban followed by Santosh. That whether an individual, how can an individual contribute towards sustainable and green bonds umbrella, and how they can take small steps to collaboratively take actions towards sustainable finance.
So, of course, the green bonds and these financial instruments are mostly traded in the primary market, with our institutional investors. Individually, if a person wants to, align their investment, there are a lot of green ETFs, or, now the mutual fund or the asset managers are also looking at coming out ESG focused funds, basically, to which are basically a corpus which is again directed towards green and sustainable projects. So those could be an opportunity to, if individual investment can be looked at from a green quotient point of view, I think.
Thank you, Anima. Santosh, you want to add something on how SIDBI is contributing to individuals' aspirations towards a greener lifestyle in a broader sense?
So individual SIDBI does not finance. So until unless effort is not proprietorship firm. So, and also on the green bond market, we are going to be we're going to take the initial steps soon. So I think Mr. Anirban has already cleared that. So.
Thank you, Santosh. We have one final question from Aniket Kumar, and it is, and I would again address this question to Huma, followed by Anirban. At the recent anti-ESG movement here described in USA, where BlackRock having conflicts regarding their ESG-backed investing, and they are one of the largest ESG investing firms globally. So, what are your views on that, and how do you see the paradigm and the landscape of ESG investment going ahead?
Okay. in my opinion, US is on the another trajectory altogether with respect to ESG. And yeah, I mean, I think I would restrict myself in answering this question at this platform because I think I'm rightly and aptly placed to talk about India at this really moment. So yes, thank you.
Anybody want to throw some light on that?
Can you repeat the question again a bit?
So Aniket is asking to shed some light on anti-AG movement in USA and the news about BlackRock having BlackRock having conflicts with investors over their ESG-backed investment. So I want to know your views on the current landscape and moving ahead on the paradigm shift, or how you see the ESG investment market going ahead.
ESG is an evolving area. The major, the ecosystem must look at the governance, how we can strengthen together, whether it is regulatory players or corporates, individual practices, or even the independent verifiers like us, which will also improve. Investor due diligence on, reliance or non-reliance basis, there are happening from ages. But then when you are integrating ESG criteria, it has to create a market confidence, right? Without showing it as a greenwashing or something, right? So that kind of level of governance, the entire ecosystem need to attain over next 3 to 5 years. At this point of time, it is not there. So there are naysayers who are definitely going to raise, doubts about maybe good or bad. There are mix of initiatives, right? So I think the governance, which is the G part of ESG, is needed to be more strengthened by all the ecosystem players together, and especially the market regulators or the government. So then I think this areas might get more minimized, or the impact of this anti-ESG movements are going to minimized. That's a thought.
Thank you very much. I hope Aniket's question is answered. So I think that's all from the Q&A section. Again, we will be sharing the presentation decks alongside the recording link to all the participants over the registered mail ID. And you can also reach out to us. I'll share the mail ID. You can mail your queries and we'll try to get back to you as soon as possible.
Thank you.
I again thank all the panelists and all the participants for the patience. It was really a wonderful session to begin with, and especially in the Indian context where we see a lot of room for financial institutions to work towards sustainable finance. Thank you all. Arun, you want to add a thank you note?
Yeah, thank you, Ribu. On behalf of EKI, I would like to thank Hima from CDP, Anirban from DNB, and Santosh from SIDBI, and Mr. Rajiv Kumar from SIDBI. It was really a wonderful program. I think it's a first of its kind program which was being focused for Indian financial institutions and banks. Hope it was very useful to all the participants, and we thank them for patiently listening to us. We'll be circulating all these presentations and information to you. And if you have any questions, you can write to us, and then we'll also share the recorded version of this session. So thank you once again to everyone.
Thank you so much.
Thank you so much, Hima, Santosh, and Victor.
Yeah.
Pleasure meeting you. Looking forward to seeing you.
Same here. Yeah. Looking forward to.
Bye.
Thank you. Bye.
Bye.